Good evening and welcome to tonight's webinar where we look at ASX investment opportunities in review. The advice provided this evening is general advice only. Investor Signals provides a broking account service which provides access to our model portfolios. If you'd like to know more about that, please contact me on 1300 614 002. The products that we provide across research, brokerage, account and managed fund. If you'd like to know more about those, please visit the Investor Signals website, or again give me a call in the office and I'm happy to explain further details on the products. Up on screen's a graph of the Nasdaq. The index remains above the 10-day average. One of the data points that's worth taking a note of is the deterioration in consumer confidence index in the US at the end of last week. We're back to some 9 or 10-year lows in that reading, which could largely be explained by the increase of the Delta variant in the US and a wind-off of the government stimulus. Whether that transpires into a slowdown in corporate earnings, it's something that we just sort of consider to be one of the first warning signs, and we just continue to watch the data in the US. We have seen slightly softer manufacturing data, but on the flip side, the services index or services data has been extremely strong. Corporate earnings, we're almost 90% of the way through the June quarter earnings. So far, if you take the average earnings of all S&P 500 companies, we're getting to a point where it's tracking up towards that $50, which is really the benchmark that was needed to be delivered to support current valuation. So it's hard to build an argument that on $50 of earnings and interest rates where they are, that the US market is materially overvalued. I think it could be maybe something in the order of 5, 7, 8, 10%. But the real story is, can corporate earnings maintain at this new sort of cruising altitude of around $50 of earnings per share? We've seen some warning from some of the larger tech companies, not that earnings are going to contract, but just that the environment over the next 12 months may not deliver the same level of growth, but not that that's necessarily needed either. As I said, if we can see earnings around that $50, then you get a level where the market can consolidate at or near where it is at the moment. As a risk off warning, if you like, we continue to take a closer look at both the Nasdaq and the S&P. If we see a close below this 10-day average, that would be a trigger for you starting to have a look at BBuzz, BBOS or SNAS, which are the inverse ETFs, and I'll touch on those at the end of this evening's presentation. The two indexes there that we continue to watch are the S&P and the Nasdaq, so both of them remain above the 10-day average. And if we have a look at our local market, we had a soft close today. But the index remains above the moving average. But you can see there I've just popped a small resistance line across the highs of Friday and today, and we'll just watch those US markets tonight and see whether they close below the average, and that could be a trigger, or it certainly is a trigger for considering those inverse products. If we look at, just for example, the Bear ETF today and just touch on this, you can see that it's had a strong day, but it really is only one day within what's clearly been a prolonged downtrend as the market's pushed higher. At an individual stock level, let's go through what we hold in our model portfolios and in the managed fund at the moment. And then, so just explaining that, if you're joining for the first time this evening, what we're doing here is clicking on the watch list, going across, selecting the ASX 100 tonight. The way I like to organise this watch list is get the percentage gains to the top and then arrange them in buy order. So we're looking at the best performing stocks today under buy signals. We'll get part of the way through this list and the stocks will shift from buy into sell. So the ones under sell are not in the model portfolio, but from a trading or counter trend point, there's a couple of stocks that I'll pause and just point out there. It is, if you're looking at anything on the short side of the market, it is worth starting to have a think about these stocks that are under sell signals that are up against resistance. So I might just draw your attention to a couple of names there as we go through those this evening. So all these stocks in the first section that are under buy, you would expect to see them in the model portfolio under ASX 100. all these stocks, the date that they were added into the model, the percentage gain, the days held, the dividends. Again, you can organise this list a couple of ways. Obviously, alphabetically, you could get the least number of days to the top to have a look at the performance of the recently added stocks, or you may want to look at it from a percentage point of view to say, well, what's the best performing stock, or which stocks are underperforming within the model. And it's only a couple of names that are underperforming. For the most part, the model's doing extremely well and outperforming the XJO. So with that, we go back into the watch list. Just to recap, we get the percentage gains to the top, organise them in buy signals, and then I'll start by moving through these. GPT's under buy signals. It's rallied off that $4.50 support, but if you've been watching the webinars over recent weeks or months, our preference within the property space is the SLF and Goodman Group, and we really haven't changed our view on that. Goodman Group is getting expensive. The earnings result was fabulous for Goodman Group, and we'll touch on that a little bit more shortly, but I still think a basket approach to these REITs through the SLF is the preferred strategy. But GPT finding support and trending higher. JB Hi-Fi, I see this really consolidating. We saw the earnings were fabulous and support the current valuation, but the company did guide towards a softer outlook, largely as a result of the lockdowns. Their digital sales were up 90 odd percent. So the story for JB Hi-Fi remains in place, but right at the moment, we're not sort of pursuing new positions in this stock. If we look at the history here, it shifted from sell conditions back to buy conditions at $22 in 2018. We've had subsequent buy signals since then. The most recent one was off this support at around $43, but I largely see JB Hi-Fi moving sideways with that support at around 43. Downer EDI is a stock that I've been mentioning and drawing your attention to in prior recordings. We like this, as we continue to do with CIMIC Group. I put a post on the blog today, just a reminder, as an alternative to buying the stock. This is in the case of CIMIC. You can consider buying call options, which gives you the right but not the obligation to take the stock up. If you'd like more explanation or review strike prices, etc. around CIMIC, don't hesitate to give me a call in the office. Downer EDI slightly exceeded their prior guidance, so earnings came in at low double digits. At around 6 to 650, it really pulls up the sort of upside potential for Downer. So I don't think it's a stock that rallies away to $8 or $9 in the short term. I'd expect to see more of a consolidation within that 6 to 650 price range, but certainly heading in the right direction. And just to draw your attention to the shift there, it's gone from sell signals under buy conditions, and at that point it was added into the model. And it's performing well. Metcash, continue to feel that this is a little expensive and susceptible to a pullback. So on the next algorithm buy signal, if you don't own Metcash, you can start to have a think about adding that into your portfolio. Our preference within this consumer staples space has been Woolworths, and Woolworths is a large holding in both our model and the managed fund, and we continue to like it, albeit recognising that Woolworths is getting a little expensive up where it is, but we're expecting to see double-digit earnings growth from Woolworths, whereas Metcash is delivering low single-digit earnings growth. The share buyback in Metcash's case is probably helping to underpin that share price advance. Northern Star, gold's fallen now from sort of 1850 back to 1750. We saw a bit of buying off the lows in gold on Friday night in the US. Hard to kind of really pinpoint the inflection point for Northern Star starting to move higher, but it is worth pointing out that Friday night, that catalyst that drove gold prices higher was a retreat in US bond yield. So we saw the 10-year treasuries back below 1.3, which was supportive for gold, and we'll just have to wait and see how that trade shapes up this week as to if those yields continue to retreat and gold moves higher. But expecting Northern Star to find support near where it is there. Mirvac Group, delivered a good earnings result. Apartment sales remain strong and underpinning earnings. The stock shifted from sell conditions to buy conditions. They're at around $2.40 and it's now pushing up towards $3. Stockland's under algorithm buy conditions there at the moment. Domino's, this is performing extremely well, and we look at this shift from sell into buy conditions here. The stock's now rallied from 70 up to 130. Again, a little expensive, and just be patient. The next pullback and the next algorithm buy signal into the back half of this year will create another entry opportunity for Domino's if you don't already hold it. Soul Patterson, under buy conditions, doing extremely well. Xero, high quality tech stock. We like this. It's the original entry level was back here at around 126, 130. It's now pushing up towards 144. It has been a stock that we've held for considerable time at different stages in the portfolio, and again, any softness coming into this over the next 6 months will be a buyer of that on the dip. We think that the underlying business remains robust, so we like Xero, we like Domino's. We're looking for car sales to move back to algorithm buy signals, and we'll look to add that. Seek, we like, but think it's a little expensive, as is the case with REA, and that really sort of covers the large tech stocks in Australia that we focus on. WiseTech Global under algorithm buy conditions, and you'll find that in the model. REA, under algorithm buy signals, you could start to think about adding a small amount of this into your portfolio if you don't own it, but I'd just be a little bit cautious this just on a valuation basis, up at 60 times earnings. Do we get sort of more of a retest of this 130 level as an entry opportunity? So just think about that from a band that are between 150 and 130, with obviously 130 being the more attractive entry level. Aurora Group, we think this is starting to get a little expensive, supported by share buyback and pursuing relatively low volatility dividend play here. But be patient if you don't already own it. Just wait for this to pull back and keep an eye out for the next algorithm buy signal. The original switch here was from sell into buy in January at around $2.40, now pushing up towards $3.70. Altium Group under buy conditions, see that really tracking sideways. BlueScope delivered fabulous earnings result, strong outlook. Algorithm buy signal here at around that $15 level, and another signal there at around 20, now pushing up to 25, 26. Maybe a little more upside left in BlueScope. Woolworths, we continue to like this, trading at around $47 or thereabouts. If you take into account the Endeavour Drink spin-off, at around $47, the company needs to deliver low teens as a level of earnings growth, and I suspect that they will do that. So I don't think the downside risks is substantial here to Woolworths, but the dividend yield is starting to compress down to that lower range of 2%. Harvey Norman's under algorithm buy signals, but again, I think if you're looking to allocate money, that's probably not a preferred opportunity right at the moment. Wesfarmers still remains our overweight position in our portfolios, but starting to, we trimmed some gains over the last few weeks, and continuing as this pushes up between $65 to $70, I think it's starting to get a little too expensive. Certainly if you don't own it, just be patient, wait for the next algorithm buy signal, and think about adding that into your portfolio. Treasury Wines under buys rallied from 10 up to around $12, at around $12 to $13. I think that's close to full value. Seek we like, but a little bit expensive here at the moment, so the original shift from sell into buy conditions was there around $25. We've had another algorithm buy signal here at around 28. If US interest rates continue to move lower, the tech stocks are likely to find some level of buying support. So it's a bit of a balancing act between the likes of REA or Seek trading at 50 or 60 times earnings and less than a 1% dividend yield, are they a buying opportunity on this dip? And the way to think about that is you really just have to manage the position size. If you are adding them into your portfolio for the first time, you need to recognise that you're paying a high multiple, and you may want to only do sort of a half position size allocation. Cleanaway reports later this week. On Friday they report their full year results, but around this 250 we think that there's some level of margin of safety there in Cleanaway. Looking for them to deliver probably somewhere around 4 to 6% earnings growth, so we'll get a clearer picture on that towards the end of the week. Aristocrat under buy conditions, one of the better performing stocks in the model. ResMed obviously been a beneficiary of, I think it was Philips product recall. Maybe that's starting to be fully priced in, and we could be getting to a point where ResMed delivers a good result, but the likelihood of that being repeated over the next 6 months diminishes, and we might need to be ready for a pullback in this and a switch to or another algorithm buy signal in the back half of the year as an entry opportunity at lower levels. Cochlear performed very well since being added to the model. Afterpay, as we know, takeover bid there, or merger with Square, which is a US technology listed company. Evolution Mining preference remains Northern Star, but Evolution under buy conditions as well. Cube, we hold this in the portfolio, supported around this $2.90 level, but the original shift was from sell conditions into buy here at around $2.50. Computershare under buy conditions, we don't mind Computershare. Our preference is Link, so we have a slightly overweight relative to Computershare position in Link in portfolios. Link under buy conditions there, so supported around that $4.90, $4.80 level. PEXA, which I've covered a little bit of in prior recordings and on the blog. Link remains a large shareholder of PEXA, and that's a technology play for you just to have a think about, which is the property settlement software that was spun out of Link. Centre Group, preference SLF, so SLF ETF. Sydney Airports rejected the higher takeover bid of $8.45, so it'll be interesting to see how that plays out. They're adamant that shareholders deserve a higher price, so we'll see how that plays out in the coming weeks and months. Macquarie Group's still comfortable with this as our preferred financial play, and it's really about the Australian banks. If you were to summarise the earnings results, the revenue growth has been fairly low, in the order sort of 1-2%. They have achieved some cost cutting, so we're starting to see that transition from 1 or 2% cost growth to 1 or 2% cost reduction. I think there's an increasing concern that the banks may not be able to materially grow revenue over the next 12 months, and that's likely to leave us in an environment where banks largely trade sideways. In the case of Macquarie, there may be an argument that they can deliver near on that sort of, say, 8 to 10% earnings growth, which is likely to be above trend relative to the major banks. So Macquarie under buy conditions, still comfortable with that at the moment. Tabcorp, we've got the separation there of the wagering and lottery business, but as I highlighted last week, even with that happening, I think it just underpins maybe the downside. It doesn't really create a catalyst to drive Tabcorp too much higher. Goodman Group, the result came in line with expectations. Guidance remains strong, so they're likely to deliver somewhere between 10 to 15% earnings growth for the next 3 years. The development pipeline remains very strong, but we're sitting on a valuation that's compressed the dividend yield now below 2%. So yes, you're getting growth, but you really are paying up for it. So again, if you don't own Goodman Group, I'd be inclined just to be patient, wait for a pullback into the back half of this year and a switch to another algorithm buy condition there. Charter Hall, preference SLF. Incitec Pivot under buy conditions. We continue to hold this in the model. In some of our trading portfolios, we've taken profit on that. IGO under buy conditions, so the switch from sell into buy conditions there at around $7, stock pushing up towards 970. South 32 under buy conditions. I'll summarize the resources once we get to Rio. In the case of BHP, it's under buy conditions there at around 45, now pushing up towards 52. You may have seen in the news today that talk about BHP engaging with Woodside Petroleum, where Woodside's looking at the energy assets of BHP. In the case of Westpac, so again summarising, we think that revenue growth's probably disappointed the market a little as we start to see these results come through, and we're maybe more of a sideways consolidation pattern in the banks. Westpac under buy conditions, CBA under buy conditions from the original entry level there at 81. We've seen it pull back following the result, but CBA is very expensive by global standards, so you're paying a premium for CBA. Largely explained away by their, I think, technology leadership over the other banks. Rio under algorithm buy conditions now, so we've seen this switch from sell conditions into buy. We've seen iron ore fall from 220 down to 160 a tonne, so iron ore's off $60 from its highs this year. Now that just puts iron ore back in line with where analysts had it in their models. So when they're working out the valuation for Rio, BHP, Fortescue, they're using $160 a tonne in their model. The relevance of that is if iron ore falls below 160 and is likely to stay below that level, then you'll see downgrades to the valuations for these resource names, especially obviously the large iron ore ones. So again, where we are in the market at the moment, I think it's important to manage your position size. So if you don't own Rio and you're adding to it on this signal, just again create a band here. You can see the lower level of that band's around 106, and you may just do half a position size here and then add to it at lower levels. And you also need to have a think about what your total iron ore exposure is. We've had BHP and Fortescue in the models for quite some time, and now we've got this shift to Rio. So whether it's a case of adjusting, say BHP as example, and starting to think about adding a little more Rio on this sell-off, and again maybe scale into that with half a position size there and half at slightly lower levels if we were to see a continued fall in those iron ore prices. Challenger delivered an okay result, performing well off that algorithm buy signal there at around $5. Fortescue, so if we look back at the history here, it's gone from sell conditions in 2018 to buy conditions in 2019. We had another buy signal there in September, and then here we are today, another signal on this correction that we've seen from roughly $27 down to $21. So if we think about this in the same way as BHP, that at or near this current price is somewhere where you could add Fortescue to your portfolio if you don't already own it, but manage that position size so you're only adding enough at this point where you can add to it at lower levels if we were to see softer iron ore. I'd be surprised to see iron ore back really below sort of 140, 145. So to me, somewhere between that 150 to 150 to say 160 thereabouts should be sort of where it starts to find support, and maybe 145 on the lower end of that band. So Fortescue we like. ALS under algorithm buy conditions. Crown under algorithm buy conditions. Obvious issues there impacting Crown and Star at the moment. ANZ, these banks take that into consideration, what I'm saying about the revenues now that you start to see sort of the trend there where the revenue growth is just not as strong as what investors probably would like to see in order to push share prices too much higher. Linus under algorithm buy conditions, IDP under buy conditions and doing well. Star Entertainment in the model portfolio, as is Santos. Santos sub $6, you could certainly start to have a think about that. Our preference remains Woodside. Unfortunately, energy prices at the moment are retracing as we see softer demand or concerns about softer demand in China weighing on oil prices. So we're seeing oil prices from say above that sort of 70 to 75 range now, tracking back around $67. So that's weighing on these energy stocks at the moment. Beach delivered a pretty soft result as well, and obviously you got the merger there between Santos and Oil Search. And now we've got this added transactional potential of Woodside Petroleum acquiring the energy assets from BHP, which I suspect should be a net positive for Woodside. So Oil Search under buy conditions, but really think about Santos rather than Oil Search. Oz Minerals under buy conditions, switched from sell into buy there, and comfortable with some small allocation to Oz Minerals in portfolios. Woodside, preferred energy stock, it's in the models. Lendlease came out with their earnings result, was at the lower end of their recent guided range, but they indicated to the market that they don't see a material recovery until 2023, and that's weighed on today's share price. But continue to think about Lendlease as a buying opportunity, but just recognising that recovery runway really is a couple of years out from where we are at the moment. Beach Energy disappointed both on the revenue and forward production. A2 Milk, so now we've switched from stocks that are under buy conditions into stocks that are under sell. So the relevance of that is that the most recent signal, rather than being a green box down the bottom, the most recent signal is a red marker. A2 Milk was it's been speculated that Nestle could be interested in a takeover bid. Now, we'll wait and see over the next sort of 24, 48 hours what further news comes out on that. But we've continued to hold A2 Milk in anticipation of either a takeover offer or a material recovery in earnings. So we continue to just hold that position, and we'll monitor the news flow there. Car sales, we like this business. The earnings result really met expectation, roughly 10% earnings growth. Most of the growth came from the international markets rather than Australia. I think Australia only delivered around about 3% earnings growth. But that really is the story for car sales, is the expansion of the business model globally. So we're happy to be a buyer of this, but not on this current rally. We'll wait until later this year until we see a pullback in the share price and an algorithm buy condition before we revisit car sales. Ansell under sell conditions. I'll move through some of these fairly quickly, and I'll just focus on the couple of names to think about on the short side. So Transurban, we think, still tracks sideways of its pressure on the earnings. Amcor we continue to like as a counter trend trade, and we hold that. Newcrest, preference Northern Star over Newcrest. APA, we think infrastructure should do well as these US interest rates seem to be under pressure at the moment. Dexus not doing there. Orica not doing there. Reece not doing there. Horizon, maybe the early signs of a recovery there in Horizon. We're starting to see it break into new highs. Later this year we may see a sell-off and a return to algorithm buy signals. Atlas not doing there at present. Next DC. So Next DC, I continue to remain cautious on that, especially if the market had a real serious risk-off move. Coles Group, preference Woolworths over Coles. Reliance Worldwide under resistance there, I feel, but we're not shorting that. AusNet, again, infrastructure continues to do well. Sonic Healthcare maybe starting to get a little too expensive, and I'd expect Sonic to shift back to buy conditions later this year on a sell-off. ASX, we like that and actually hold that despite it being under sell conditions. Brambles, we think high quality business, but maybe a little expensive where it is at the moment. Nine Entertainment not doing there at the moment. NAB, within just on the banks. So we have ANZ, Westpac, CBA under buy conditions, and Macquarie. The other alternative is the MVB, which is a ETF. And if you're wanting to think about the banks at a global level, the BNKS ETF, we're holding that still at the moment. Magellan's under sell conditions, Medibank under sell. The rally's probably been a little bit stronger than I expected in Medibank. It has rallied into a new higher. Pullback later this year may see that shift to buy signal. Spark Infrastructure doing well. Suncorp delivered a good earnings result. Suncorp, so insurance margins were solid. Banking result was good. Helped to lift the insurance sector in general. QBE, IAG. Our preference within the insurance sector has been to play a recovery for IAG, but the actual sector's performing well. CSL, so it's under sell conditions at the moment. It's tracked sideways within sort of this 250 to 300 range. What we're now looking for this to be added back into the models is a pullback to around about this 260, 270 level, and I'd expect to see that trigger a buy signal, and we'll add that into models when that occurs. Ramsey Healthcare, we hold this just as an income contributor to portfolios, but we don't really see it trading too much higher. Insurance Australia Group's had that bounce from 480 up to 550. We hold that. James Hardie maybe starting to get a little expensive. The earnings result really delivered everything that the market was expecting. But it's interesting when you look at sort of the housing data. If you were to, and I might try to put a graph up on the blog tomorrow of lumber prices. There was a lot of commentary in the media about how expensive lumber was getting in the construction costs of housing. But if you actually look at it, the lumber prices have crashed back, well below where they started prior to this recent rally. So I'll pull up a graph and add it onto the blog tomorrow. You might find it interesting, and maybe there's some conclusion that you can draw from that as to the impact on housing over the next 12 to 24 months. And it's really a US story, but James Hardie delivered great results. Just a matter of whether it's starting to get a little expensive up where it is there at the moment. Vicinity, not doing there at present. QBE, it's broken out. So a couple of these stocks that have broken out into new highs, I'd expect to see on a pullback later this year a number of these stocks added into the model portfolio. So we're getting to a point in the market where you're probably not seeing generally too many buy signals, but what we're looking for is into the back half of this year some new names to be added into the models, which will be examples of stocks that may have been in downtrends and they've broken into new highs, and then we're looking to capture the beginning of new bullish momentum in those names. So I'd expect we'd start to see a bit of a shift in the model portfolio allocations into the back half of this year. Telstra delivered good earnings numbers, as I alluded to in prior recordings. The outlook for Telstra was improving, and we are seeing them actually lift their earnings guidance from roughly $6.8 billion profit. That increases to $7 billion next year. So the dividend's safe, it's attractive in this market, so we don't think the downside is substantial there for Telstra. AGL not doing there, clearly making lower lows, lower highs, under sell signal. Alumina under sell signal, that's no longer in the model portfolios. Ampol under sell. Fisher Paykel, great business, just too expensive. It's under algorithm sell signals there at around $30. Bank of Queensland, we're still cautious on the regional banks. Boral is subject to the takeover there of Seven. Qantas Airways under sell conditions, which probably is appropriate. Worley's under sell, not doing there at the moment. Mineral Resource, think that's getting too expensive, and we'll look at that later this year. Origin, possibly a counter trend trade here in Origin. The earnings results from the retail electricity side of the business were terrible, as is the case with AGL. The bright spot for Origin is the dividends coming through from the LNG sales. retail electricity prices are improving for the main operators, so we may start to see a slightly better outlook for earnings for Origin. So just keep that in mind, and we'll watch that for a breakout to a higher high. AMP cautious there, Bendigo cautious there, and there we are back to Endeavour. So just a couple of ETFs that we've been looking at. The Tiger, the Asia Technology Tigers, this whole complex remains under pressure as a result of slightly slower growth coming through out of China, and also obviously the regulatory response. Just keep an eye on this if you don't own it. It's corrected from $14 down to $10, so we've had roughly a 40% correction there. The downside risk could be further given sort of the uncertainties around regulation, but maybe just add that one to your watch list and keep an eye on it. The Cure ETF we continue to like as a growth opportunity. We think that somewhere down around this level starts to get down to a point where there's an inflection, and we could see a multi-year trend higher in Cure. It tends to outperform the S&P 500, but it has become expensive, and when it was trading up at around that $85 just from a PE standpoint with the underlying constituents, and you've just seen a realignment of it where it's now really pulled back to a point where it's tracking in, not outperforming but tracking in line with the S&P 500. So looking for this to find buying interest at around this $55 level. Just to touch on that property ETF, the SLF, so we continue to like this. We can see the recent buy condition there, as was the case back in February. And in next week's recording, I'll cover a bit more detail, a broader look into the ETFs that we're holding, and also revisit what I'm posted on the blog. Thank you for listening in, and if you'd like to discuss the broking account service or just revisit any of the analysis in tonight's recording, please don't hesitate to contact me on 1300 614 002. Look forward to speaking again next week.